Hello, welcome back from lunch. Hope everyone's full, sated, enjoyed their meal. Because we've got a lot more for you to digest here coming up. First up, the power of liquidity. It's powerful. How so? Why? How's it work? We're going to unravel these mysteries today. And we got just the man for the job, Seg. He's going to be hosting a panel with Alain Kunz of GSR. He's the managing director of. The head data and risk of Rings, William. And the founder of Jigsaw, Dauphin. So please give them a round of applause as they come onto the stage. Oh, wait, no, never mind. We got to wait for the chairs. Once they have a place to seat, let's give them a round of applause. Thank you, thank you. Thank you for working with me, folks. Okay, well, I'll vamp for another second or so up here. I know liquidity is really important to you guys. It's really important to me, right? You don't want to be the exit. All right, here we go.
Amen.
All right, guys. Yeah.
Hey everyone, hope everyone's still awake. We have a really interesting panel for you today. It's called The Power of Liquidity. It's sort of ever-present in our lives, and we use it every day, but we don't really necessarily think about it all the time. And these are the guys making it all happen. And so I'm going to introduce each of them and ask them to describe your protocols. So we have Alain, I'm not going to try to pronounce your name, from GSR, Managing Director. We have William from Rings, and we have Eric from Jigsaw. Yes, so let's start with Alain. Please introduce yourself and tell us a little bit about GSR.
Hey, my name is Alain. I'm a managing director at GSR. I mean, GSR is not a project. It's actually a liquidity provider or market maker, as well as a multi-stage investor. I would say our core premise is that we see in Web3 liquidity being part of the infrastructure.
Nice. William?
All right, nice to meet you guys. First time for me on stage, so usually our founder's job. So yeah, besides what's written on my card just there, I've been working crypto like around 4 years, essentially contributing to project growth and emotional support to our beloved devs, you know. So yeah, about Rings, and I think we're getting to the interesting part. It's often misconceived as a stablecoin protocol, stablecoin issuer. I think we are more like we will describe it as the best exposure to that, say, the stablecoin industry. So not going too technical, but it's like, yeah, generating yield, redistributing this yield across applications, fueling the Sonic ecosystems, and enabling builders build great tokenomics instead of focusing on incentive costs.
Nice, nice. And Eric?
Hi, everybody. My name is Eric, and I am a general partner at Manifold Trading, as well as the founder of Jigsaw Finance. Jigsaw is a CDP stablecoin protocol that allows users to maintain full composability, flexibility of their assets while also taking a loan in our stablecoins.
Nice. Okay, cool. I think, could you describe a little bit more about why people use Jigsaw over your competitors? Just real quick, I'm curious personally, yeah.
Yeah, so with Jigsaw, well, with a lot of our competitors, you would deposit a singular asset such as ETH or a stablecoin like USDC or USDT to mint out their stablecoin. And whatever yield you'll get would be specifically derived from whatever they say. With Jigsaw, we give you the optionality of depositing a wider range of assets, such as LSTs, LRTs, RWA stables. And when you deposit it inside of our vaults, there are other DeFi protocols, such as Silo, Rings, Aave, etc., where you can choose where you want to have your yields derived from. So instead of being trapped to whatever the protocol says, you get to have the full flexibility to derive your yield from your choosing. And it allows more flexibility. It's your choice, and the option's all yours.
Like a jigsaw.
Like a jigsaw.
Nice. Cool. Okay, so I'm going to ask each of you one question that I think is pretty important, and it'll shed some light as to how you guys, your own internal like philosophies on liquidity, healthy liquidity, etc. So, how do you define healthy liquidity, and what are the key metrics you monitor to assess healthy liquidity? Starting with GSR.
Okay, I mean, I'm probably going to start out with just giving an intro what liquidity is, because it's like a word that gets thrown around, but I think a lot of people don't really have an understanding what it is. I mean, a very simple way to look at this is basically the ability to move from one asset into another one without having a big impact. Now, every time you talk about liquidity, you also can think about having a trade-off, and the trade-off is essentially how fast you can move from one asset into other versus the price you actually will get. So the faster you want to move, normally the higher the price impact, the more time you have, the less it is. Now when you look at liquidity generally, there is probably the spread that you can look at to. That's like top of the book spread, so that's like the shortest distance between bid and ask, so where you can buy and actually sell it. I think that's one good way to look at it, but I think the other one is also the depth. That actually means how much you actually can buy and sell. And I think that's the two most important criteria we look at from our standpoint.
Just a note on that before we continue. So I think some of us have encountered the concept of slippage as well. And I think that when you see, for example, something with a market cap of $10 billion and a price of token price of like $10 or whatever, right? Like the real metric that defines the value of that asset, as Alain was describing, is really the depth of the liquidity that allows people to buy and sell into that asset. Because if it's, I mean, the price you see at the headline, a lot of people just take it at face value. But if the liquidity is super thin, you sell $100 worth of it and it crashes 90%. That price was a sort of a fake indication of the actual underlying fundamentals. So that's something that is a basic concept. I think most people understand it, but some people don't. And I actually am surprised to see how many people don't understand the concept of liquidity and also unit bias when it comes to actually evaluating a project or a token or an asset. So I think that's very important.
I mean, you meant slippage. I think when we talk about healthy liquidity, it's basically minimizing the slippage. It's another way to look at it. The bigger the slippage is, the unhealthy the liquidity has been if you put in the transaction.
I think I have a bit of different opinion on this. Is like, if I was to describe healthy liquidity, I will first say it's about sticky liquidity as opposed to mercenary liquidity. You know, you can have whales deepening your pools, but if they are here to extract maximum value from your token and then rotate to the new Chinese protocol, it's not really worth nothing. If you think of it in a quadratic way, you would rather have 100 smaller LPs, governors, or community members that will enhance much further your market sustainability, you know, and push your project.
Yeah, no, definitely. And I think that a lot of, when you hear the term market manipulation, it has a lot to do with liquidity, and it's intertwined with liquidity. So if people want to push up the price of something, like as an example, if there was a big liquidity provider, they could pull out all the liquidity, make the slippage extremely high, and buy, and then it would push up the price extremely fast, and that might not be indicative of what actually the value of the thing is. And so what William was saying was basically like you want to have a decentralized liquidity base that allows you to be more robust to individual whale movements of liquidity, etc. Right? Yeah, Eric?
Just bouncing off what William said, the concept of having too much liquidity concentrated in one place does cause the slippage issues. And especially with the DeFi setup in stablecoins, right? You want to make sure that the community has enough ways to transact amongst each other. Like if there's not enough people holding said liquidity or holding said assets, there's not going to be any reiterations on how your assets can be used. So it's become stagnant. And so you have these different forms of stablecoins that are backed by yields, treasury yields. Well, if you have a bunch of liquidity that's idle or doesn't have any utility, it's nothing more than a T-bill with smart contract risk. And what's the point of having that?
Yeah, definitely. I think that's an important point as well that I think some builders also overlook. It's that if you're taking real-world sort of assets and things like that and putting it on chain, you think about what's the additional utility you're providing by putting it on chain. So if you're taking something that has a yield in the real world, putting it on chain like T-bill, it should come with additional utility or additional use cases, because otherwise you're doing it in name, but then also you're just creating an additional layer of risk that then the end user has to bear. So I think use case for real world assets is something that I agree is very important. That should justify the additional risk you're taking. Yeah, great point. Okay, so next question I wanted to ask was, what are some of the biggest misconceptions about liquidity provision in decentralized markets? So you have central limit order books, you have AMMs, you have these different types of markets that you can interface with. But specifically in decentralized markets, what are the misconceptions that you're aware of, Alain?
I mean, what are the misconceptions? I think if you look at AMM or center order book, what you just mentioned is like two-way. How we look at it is like different kind of capital efficiency, how you use it. And then the AMM is probably on average less efficient than just a normal order book. So you mentioned your preference for smaller people providing the liquidity protocol. I think from a protocol standpoint, I can completely understand that, because I think not enough people actually make a proper calculation about opportunity costs. Because it's very simple. If you have $1, you can just lay it around. You can put it in real-world asset. What you mentioned, you get the yield. You also can put it somewhere at risk. If you put it at the AMM on the highest level, you have some kind of impairment loss risk. At the same time, you basically have an opportunity often to just farm a token, which makes people crazy. It's basically a bit feared or fueled by FOMO. But I think it's also leading to just a lot of what we call it, mercenary liquidity. I mean, we saw it in all the stablecoin vaults that we had, like Q3, Q4 last year. They were just yielding like 20, 15%, where you're just going to say, like, it's just not possible. If you cannot do it on the dollar side, it's not. And there were a lot of incentive. And I think the moment the incentives go away, all the liquidity disappears as well.
I think I'll counter that slightly. The liquidity can come in, right? But it's on the protocol itself to be able to maintain the user as they come in. Like, make something good enough that the user will want to stay after everything dries up.
Of course, the product market fit needs to be. It's cannot only be your token that you basically give away for attracting that.
Yep.
Nice. Actually, one thing that occurred to me, just maybe a philosophical thought that might be interesting, is that when you're describing LPs and mercenary liquidity, it occurs to me that the way that validators stake to protect the chain and secure the chain, and they can remove their stake, it seems to me similar to the way that LPs sort of stake or put in their liquidity to protect the depth of the assets liquidity. So it's like if you're an LP provider, you're basically a validator for the asset in a way. So it's just an interesting philosophical point where you're basically putting assets at risk, sort of, to protect something. If it's a protocol, then it's LP. If it's a chain, then it's the actual base asset. So last question before we wrap up. I wanted to ask, what's your view on token incentives and yield farming to bootstrap liquidity? Is it an effective tool or short-term crutch?
I mean, look, I think the idea of Web3 or having a token to incentivize any kind of behavior is a very interesting way. I agree with Eric's last point we bring up. I mean, it's a good way to bootstrap. It's a bit the same thing like when PayPal got started. They basically gave everybody, I think, $10 that signed up. But that's just a short-term incentive structure you can have. But you cannot do that for all the people on the planet because it's not going to work out. I think the same approach is on the project side that actually use token. You just need to use them to change a behavior, but you want to have the client or the user sticky on your platform, not the moment they get the token gets somewhere listed, they just disappear. So you need
the mercenary point.
Yeah, then we're back to the mercenary point, and it's not really helping because you only have farmers with the wrong incentive. They're going to dump on you. Your price chart is going to look very bad. All your future effort is going to be very hard to do. So you need to basically channel. It's just like if you think about a channel, the liquidity or the token incentive is just to get them the footstep in, but they need to go some form down a value chain that makes them sticky and provide something else than just a token.
Actually, to make one last time to make the devil's advocate, I think token incentive is a very solid way of bootstrapping liquidity. I'm not telling it cannot be sustainable, and I'm not talking about longer and longer emission schedules. But I think it's a very good way to align users with your protocols, and it can be like if it's combined with mechanisms like buybacks or other even complex C or flywheels, it can become a long-term thing, I think.
Yeah, definitely a really good point. the people who are providing the fundamental, invisible infrastructure for our chain. Thank you guys. Appreciate you so much.
Thank you.
Thank you.